Hi everyone, and welcome to the Marine Hull Insurance course. Today, we're going to break down the fundamentals of marine hull insurance in a simple and structured way. To understand marine hull insurance, we need to start with the scale of global shipping. Almost everything in the modern world moves by sea. Close to 90% of all international trade relies on ships, and the value of that trade sits somewhere between $24 and $33 trillion. But the industry is under pressure. Freight rates and shipment volumes have been falling as the world deals with inflation, recession, the after effects of COVID, and trade tensions between major economies. When countries introduce tariffs or impose sanctions, ships don't just lose cargo, entire trade routes shift. Geopolitical risks are adding even more strain. Attacks in the Red Sea have forced hundreds of vessels to abandon the Suez Canal and reroute around the Cape of Good Hope. This adds thousands of miles to each voyage, increases fuel consumption, raises emissions, and stretches delivery times by weeks. Today, the global merchant fleet sits at well over 100,000 active vessels, with a combined asset value between $1 and $2 trillion. Every one of these ships represents a moving concentration of capital, and every disruption in global trade directly affects the risks that hull insurers must absorb. Number 2. Types of ships. The global fleet is incredibly diverse, and each type of vessel brings its own characteristics and insurance challenges. The ships most people recognize are container vessels, the backbone of consumer trade. Then we have tankers transporting crude oil, refined products, or liquefied gas. Bulk carriers move raw materials like grain, coal, and iron ore. Roll-on roll-off ferries move vehicles across short sea routes, while cruise liners operate as floating cities. Beyond these, there are thousands of specialized craft, offshore support vessels, fishing boats, tugs, dredgers, and many more. To understand how these ships are assessed, we use a few key measurements. Gross tonnage tells us the internal volume of the ship. Net tonnage focuses on the space that actually earns money, the rooms and holds used for passengers or cargo. Deadweight shows how much weight the ship can safely carry, including fuel, provisions, and cargo. And for container ships, capacity is expressed in TEUs, meaning how many 20-foot containers the vessel can take. The values of these ships can vary dramatically. A standard commercial tanker, bulker, or container ship might be worth between $50 and $200 million. At the top end, the largest cruise liners can exceed $2 billion. This range in values is a major driver of how hull insurance is structured and priced. Number 3. Industry changes and emerging risks. The shipping industry of today looks nothing like it did a few decades ago. Traditional break bulk vessels that once carried crates and individual pieces of cargo have largely disappeared. Containerization took over and reshaped global trade. Cargo is now standardized, lifted by machines, and loaded at a scale that was unimaginable a generation ago. As a result, ship size has grown dramatically, with modern container ships stretching 400 meters and carrying tens of thousands of containers in a single voyage. That growth has created new challenges for insurers. Salvaging a vessel of this size is far more complex than rescuing older, smaller ships. There are fewer shipyards capable of repairing them, and firefighting on board such massive structures is extremely difficult. The rise of electric vehicles has added another layer of risk. Lithium-ion batteries can ignite through thermal runaway, producing fires that burn hotter, spread faster, and can reignite long after they appear to be extinguished. Accumulation risk is another growing concern. One vessel now carries cargo values that once required an entire fleet. At the same time, port congestion and bottlenecks mean ships often wait days offshore, increasing exposure, and on the fringes of the industry, a growing shadow fleet of tankers moves sanctioned oil using poor safety standards, falsified documents, and unreliable insurance. These vessels create serious environmental and liability concerns. All of this is happening while shipbuilding has shifted heavily to Asia. China, South Korea, and Japan now dominate global ship production, shaping the supply, capability, and cost structure of the entire industry. 4. Hull and machinery insurance. Hull and machinery insurance sits at the core of a shipowner's protection. It covers physical loss or damage to the vessel itself, including the hull, the engines, and all essential operating equipment. The cover also responds to the ship's share of general average contributions, the salvage charges that arise when a vessel is rescued from danger, and the collision liabilities that fall on the owner when the ship strikes another vessel. By default, only 3/4 of collision liability is covered, but owners can extend this to full liability if they wish. Certain perils are excluded in order to keep the policy focused on navigational risks. Losses from war, strikes, malicious acts, nuclear hazards, and terrorism are handled separately by specialist war and strikes insurers. Hull and machinery insurance is written as an annual time policy. Before cover begins, owner and insurer agree the value of the vessel, which must reflect either its replacement cost or its earning capacity. Because a total loss can create additional financial pressure, many owners purchase an extra layer called disbursements insurance, usually up to 25% of the whole value. This protects freight earnings, stores, bunkers, and other interests that would be lost alongside the ship. Together, these elements form the foundation of a shipowner's risk protection and underpin the broader structure of marine insurance. 5. Buyers and brokers. The buyers of marine hull insurance are incredibly varied. At one end of the spectrum are the major shipowners who operate fleets of tankers, container ships, bulk carriers, or cruise liners. At the other end are private individuals who simply want to protect a small yacht or pleasure craft. Despite this range, the fundamental structure of protection for commercial vessels is always the same. Every ocean trading ship needs hull and machinery insurance for physical damage, P&I cover for liabilities to third parties, and war and strikes cover for geopolitical risks. Because these policies interact with classification rules, international conventions, warranties, sanctions restrictions, and trading limits, most buyers rely heavily on brokers. A broker's role is more than just finding the best price. They help shipowners understand the cover, gather technical information for underwriters, and navigate a global market made up of specialist insurers spread across different regions. For large commercial fleets, the broker becomes an essential advisor guiding the owner through complex risk, compliance, and placement decisions. 6. The marine insurance market. The marine hull market is global, but most of the premium comes from a few key regions. Europe accounts for more than half of the world's hull income, followed by Asia with more than a third. Together, they dominate the sector, reflecting the concentration of major shipowners, brokers, and specialist insurers in these regions. Despite the size of the market, underwriting profitability has been difficult for many years. Since 2005, competition and excess capacity pushed premiums down while vessel values continued to rise. This mismatch eroded margins and produced long periods of underperformance. Only after 2020 did the market begin to stabilize. Claims inflation, larger vessels, and previous losses forced insurers to raise rates, bringing some improvement to results. Claims trends tell an important part of the story. Total losses have dropped significantly over the last decade thanks to better safety standards and more reliable vessels. But partial losses remain common, with machinery damage consistently ranking as the leading cause. At the same time, emerging risks are changing the landscape. Lithium-ion battery fires on container ships and car carriers have increased sharply, adding new complexity and cost for insurers. Overall, the market remains large, specialized, and deeply influenced by global trade patterns. Every shift in shipping behavior, technology, or regulation is felt directly in the results of hull underwriters. 7. Protection and indemnity clubs. Protection and indemnity clubs provide the liability cover that sits alongside hull and machinery insurance. While the hull policy protects the ship itself, the P&I Club protects the shipowner against the wide range of liabilities that arise from operating a vessel. These include injury or death to crew members, pollution from spills or leaks, damage to cargo, and the portion of collision liability that exceeds what the hull policy pays. The clubs operate on a mutual basis, meaning the shipowners themselves are the members and effectively insure one another. 12 of these clubs form the International Group, a powerful network that shares large losses and purchases reinsurance collectively. Through this structure, the clubs can offer protection limits that reach more than $3 billion, providing a level of security that a single insurer could not realistically offer. In recent years, fixed premium P&I products have grown in popularity, especially among owners of smaller craft and coastal vessels. These operate more like traditional insurance policies and avoid the variable costs associated with the mutual system. Even so, for blue water shipping, the International Group remains the backbone of global marine liability protection. 8. Construction risks. Before a ship ever enters service, it faces a long and complex construction process, and this phase carries its own unique risks. From the moment the keel is laid until the vessel completes its sea trials and is handed over to the owner, the shipyard, contractors, and future owner all need protection against physical loss or damage. This protection is provided by builders' risks policies or by the more modern MARCA wording. Unlike hull and machinery insurance, which is based on named perils, construction cover is written on an all-risks basis. It responds to accidental loss or damage during fabrication, machinery installation, launching, fitting out, or trials. Collision liability is included because the vessel is not yet eligible for P&I Club entry. War and strikes risks are excluded from these policies, but they can be purchased separately if needed. Construction periods often run well beyond 12 months, especially for large vessels, so these policies remain in force for the entire build. They form a crucial bridge that protects the project until the vessel becomes a fully operational and insurable ship. 9. Claims concepts. Marine hull claims follow a set of principles that are unique to shipping. Most incidents result in a partial loss, where repairs are needed to return the vessel to service. In these cases, insurers pay the reasonable cost of the repair along with associated expenses, such as moving the vessel to a shipyard. An actual total loss is far more severe. This is when the vessel is destroyed, sunk, or lost beyond recovery. But a ship does not need to be on the seabed to be treated as a total loss. If the cost of repairing the damage, combined with the cost of recovering the vessel, is greater than the ship's value once repaired, the situation becomes a constructive total loss. In this case, the owner has the right to abandon the vessel to insurers and claim for its insured value. Salvage plays an important role in many marine losses. When a ship is in danger and another party assists in saving it or its cargo, the salvor is entitled to a reward. These awards can be substantial because they reflect the value saved and the risks taken. General average is another distinct feature of marine claims. when a sacrifice or extraordinary expense is made for the common safety of the ship and cargo. All parties share the cost proportionally. The process is governed by the York-Antwerp rules and is managed by specialist average adjusters. Their calculations determine how much each party must contribute and how the claim interacts with hull cover, cargo insurance, and the shipowner's responsibilities. Together, these concepts form the backbone of marine claims handling and explain why marine insurance requires such specialized expertise. 10. Legal framework. The legal foundation of marine insurance is built on principles that have shaped the industry for more than a century. The Marine Insurance Act of 1906 remains the core legislation, defining how policies work, how claims are settled, and what responsibilities fall on both the insurer and the insured. The Insurance Act of 2015 modernized some of these rules, especially around disclosure and the handling of warranties. Several key principles always apply. Insurable interest requires the policyholder to have a genuine financial stake in the vessel or the voyage at the time of loss. Seaworthiness is fundamental. The ship must be reasonably fit for the voyage it undertakes, and owners must take steps to maintain that standard. The duty of fair presentation requires the owner to disclose all material facts to insurers honestly and clearly. Warranties and legality ensure the vessel's operations comply with international and domestic laws. Alongside these legal principles sits the regulatory framework of the International Maritime Organization. Conventions such as SOLAS govern the safety of life at sea. MARPOL sets global rules for pollution prevention, and liability conventions define how shipowners must respond to incidents involving collision, cargo damage, or environmental harm. Together, these rules create a structured environment that protects owners, insurers, and the wider maritime community, ensuring that risks are managed consistently across the world's oceans. 11. Current issues. The marine insurance sector is navigating a series of major challenges that are reshaping how risks are assessed. One of the most urgent is decarbonization. Shipping emits close to 1 billion tons of carbon dioxide each year, around 3% of global emissions. The International Maritime Organization has set ambitious goals, calling for a 40% reduction in carbon intensity by 2030 and a transition to net zero by 2050. These targets are not just regulatory milestones. They influence how banks lend, how insurers underwrite, and how shipowners operate. The Poseidon Principles now link financing and insurance decisions to the environmental performance of fleets. Meeting these goals requires new fuels such as LNG, methanol, and hydrogen. While promising, they introduce unfamiliar risks. Insurers are concerned about failures at sea, the handling of volatile fuels, and the possibility of large salvage claims if engines or systems fail far from shore. Some owners are reducing emissions simply by slowing their vessels, but this increases voyage times and extends the period during which a vessel is exposed to navigational hazards. Geopolitical tensions are another pressure point. Attacks in the Red Sea have forced vessels to divert thousands of miles around the Cape of Good Hope, raising CO2 output, increasing operational costs, and driving up war risk premiums. War cover now carries a 72-hour cancellation clause when major powers are involved, reflecting how quickly conditions can change. Alongside these issues is the rise of the dark fleet, a shadow network of more than 600 tankers moving sanctioned oil. These vessels often switch off tracking systems, falsify insurance documents, and operate with poor safety standards. They pose serious pollution and liability risks, and any collision or spill involving them creates massive complications for legitimate insurers. 12. Future outlook. The future of marine hull insurance will be shaped by rising values, evolving technology, and a more volatile risk environment. Newbuild orders remain strong, and modern vessels are becoming larger and far more expensive. This increases both the exposure for insurers and the capital required to participate in the market. War risk is expected to stay unpredictable as geopolitical tensions continue. Underwriters will need to adapt quickly to sudden changes in trading routes, sanctions, and regional conflict. At the same time, fire hazards linked to electric vehicles and lithium-ion batteries are growing, especially for container ships and car carriers. These incidents can escalate rapidly and are difficult to control, increasing both severity and uncertainty. Environmental alignment will become a central part of underwriting. Insurers face pressure to measure and disclose the climate impact of their portfolios, and shipowners will be expected to demonstrate progress toward decarbonization if they want favorable terms. All of these factors point to a market where premiums continue to rise. Many Lloyd's syndicates and international insurers have already withdrawn from unprofitable marine lines, reducing capacity and pushing rates upward. As vessels become more complex and risks become more interconnected, hull insurance will demand even greater technical understanding from underwriters, brokers, and shipowners alike. That brings us to the end of this marine hull insurance overview. I hope you found this useful. Feel free to like the video and subscribe for more courses. Thanks for watching.